This is Eric Muather with Muather.com for the week of February the 6th, 2012. Let's take a look at what the markets are looking like on the charts here. We begin with the Nasdaq 1-year daily, which is screaming to a fresh 52-week high as we speak right now. The daily gap up, there's a huge gap up today as it clears a previous resistance that were 1-year resistance going back all the way to May of 2010 or 2011. So breakout to new highs with a screaming breakout here. The thing we need to be very careful here is to argue with what we see, which is a market that it has been continually pushing higher. We see that even the 50-day moving average, the 200-day moving average, they are all starting to coil higher. So it really would be a mistake to pick a high. It's very difficult to pick a high. Let the market form its own high, then you can trade any pullback. But for now, this market is screaming to fresh 52-week highs. Why argue with that? If we take a look at the Nasdaq weekly chart, we see that we are going into a multi-year breakout level. This is a multi-year breakout level. We are also above this declining line here, which is bullish. So as far as the price is concerned, there is really no point in arguing with the market. At some point we might get a pullback, but until you see the pullback and the nature of the pullback, you have to be very cautious. Now, another thing I need to point out here is you see now we have the crossing over of the 33-week moving average and the 10-week moving average. That's a very bullish setup. What that suggests to me is that even if we get a pullback, it might suggest that it's going to be a shallow pullback in the beginning. Our pullback is going to probably bring the market back to this 50-day, to this 10-week moving average and the 33-week moving average. So it's going to be a shallow pullback at first. We'll see what happens whenever we get that kind of scenario, because you're going to have some support coming from this downside support coming from this moving averages whenever the market pulls back. In actuality, so you need to play the upside, play breakouts until the market changes the way it looks. Right now it looks very strong. You take a look at the Nasdaq from a monthly perspective. This is a 30-year monthly chart for the Nasdaq. You see we are at 11-year highs, close to 11-year highs, 10-year highs, as the Nasdaq is breaking out this month. That's a big deal. Now we'll see whether it's going to hold that level the end of the month, but for now it is what it is. It's a breakout and you have to respect it for what it is. The Dow is slightly lagging, and I'll show you why that is. You see the Dow here this week trying to move to fresh 52-week closing highs, depending on where we close for the first week of February, first trading week of February here. But as of right now, really nice breakout. Now remember, all the moving averages already, you know, this, once we had this crossover of the moving averages here, the market was always poised, you know, to move high, because that crossover always tends to predict where short-term direction is. Let's take a look at the Dow from a daily perspective. You see now, initially we were struggling to hold these declining top lines, but now we've settled above it and are pushing high towards the end of the week here. Also, we are touching fresh 52-week highs, I'm sure, as you are aware. So really, unless the market turns around, and the nature of the turnaround, you really have to play the upside. Otherwise, playing the downside is really risky. We'll see how things shape out. If we take a look at the RSI on the Dow, you'll see that going back a couple of weeks, once we broke out above this declining line here, once there was a breakout of that RSI trend above the brown line here, the market was breaking out, and it had, you know, the opportunity to move higher, which it's doing right now. Also, we have the crossing over of the 50-day moving average, crossing above the 200-day moving average. So what I was saying when I was showing you the Nasdaq chart, you know, initially, even if the market pulls back, we have an upward trending 50-day moving average. So initially, any pullback is going to contend with the support coming from the 50-day moving average. So what I'm saying is, really, you have to play the upside for a while, because the market is just not going to crash. It's going to pull back and then try again to break out, because you have support coming from this upward trending moving averages. Let's take a look at the Dow now. I say the Dow is lagging the Nasdaq because unlike the Nasdaq, you see that the Dow's high is at about 14,000, which it made in late 2007, and we are ways off that. So the Nasdaq is leading, technology is leading markets to in this rally. The large cap stocks slightly, trailing behind that in terms of performance, but they are also trying to break out to a multi-year breakout, about 3-year breakout on the Dow. But the Nasdaq is definitely in the leadership position. The S&P 500 has yet to break out to fresh 52-week highs, but it is, constructive, and it is, working on its way to move higher as we see the crossover between the 10-week moving average and the 33-week moving average. So, given this chart, you have to assume that it's going to also follow the Nasdaq and the Dow and try and break out. That's the indication here. The S&P 500 from a multi-year chart, this being a 20-year chart, you see that S&P 500 all-time high is closer to about 1550, somewhere around there, and it had a double top here and here, so we are ways off all-time highs as far as the S&P 500 is concerned. Again, technology is leading this market. If you take a look at the QQQ, it's held above our level which we are watching. It's above 59.32, suggesting to us that we still continue playing the upside as far as technology is concerned. Play breakouts, because this breakout is now working on its third straight week of positive close above this breakout level. Look, unless the market pulls back, when it does, you don't know when this rally is going to end. There's no need in trying to predict the top. Just play what you see. Right now the trend is to the upside. Let's take a look at the internet index. And what I wanted to point out here is, I was wondering whether the last time we had this declining level here, once we broke out about this declining trend, we went into almost a 5-year rally, 4-year rally from 2003 all the way to late 2007, and then again in middle of 2009, this trend here was broken to the upside, and we had a nice 1-year rally, almost 1.5-year rally from mid 2009 to the beginning of 2011. Right now we see that this trend has been to the downside, and now this month we seem to be pushing outside of that trend. Leads me to wonder whether this is going to be a multi-month rally. That being the case, it really is, the risk is to be short right now. Take a look at the IYR, which is a real estate index. You'll see that it is also pushing to a multi-year levels, going back all the way to pre-2008 crash. So it is breaking out here. Really, you have to say it's a surprise, but this sector, which was one of the worst on the way down in 2008, 2009, we are now breaking into levels not seen going back to middle of 2007, when the subprime mess hit the general market, or became the talking point in the Wall Street. So we are back to 2000. Let me do that differently. We are back to 2000 and mid 2007 levels, right there, above those levels. So you cannot ignore this. You have to just play the upside until we see a significant pullback. The XHB, which was struggling, as you can see, for a couple of days there, maybe even 2 weeks, could not hold above this 52-week high, but it has managed to spike to fresh breakout levels. This XHB being the home builder sector, so you have to play the uptrend now that it's doing very well. Initially we had this declining top line here, which we broke out, came all the way here, settled here for a while as we considered our next move, and we blasted to the upside. So the risk here is just going short, and you just need to play the upside in this market for as long as the market is trending higher. XHB, again, on a weekly chart, we were finding it difficult to stay above this top line here, but we've since, especially this week, broke out definitively. So you wanna stay long the market. Let's take a look at some ETFs here. This is a EDZ, 3 times bear emerging market, and you see that once we broke down, we had a wedge here that was forming here, but about 4 weeks ago we broke down, and in breaking down we've had straight down weeks, all-time lows here. In other words, the emerging markets seem to be moving higher as this EDZ breaks down. That just means that you want to continue playing upside in the market, because even the ultra short ETF, this is now the FAZ, 3 times financial space, had an opportunity of breaking out here, but actually decided to break down, and that's why we are seeing all-time lows on this FAZ. Really no reason to own these ultra short ETFs. Here is a FAS, which is the bull financial ETF. You see that this last 3 days it's pushed out of this declining top line here. It's pushed out of that. It's breaking out on a short-term relative basis, also above this trend line here, making it a 1, 2, 3, 4, 5, almost a 6.5 week break, 6.5 month breakout, moving above the declining top line. Now we are back at the 200-day moving average. We'll see how things shape out in the coming days, but for now, you just have to play the market from a bullish perspective until the charts change. Here is a TZA. As the Nasdaq is making multi-year highs, you see that the ultra short financial bear, small cap bear ETF is breaking down to fresh 52-week lows. What that tells me is you want to avoid the ultra short ETFs around here until the market changes its look and feel. Now the dollar has not had the market's been very strong on the first week of February here, but the dollar is almost unchanged for the week. Now what I'm seeing here is the dollar is trying to find support on its 33-week moving average, okay, and also the RSI. The dollar's RSI seems to me to be finding support on this green line here. It's finding support here. So depending on how things go over the next couple of weeks, I think if it bounces, if we see a bounce that takes the dollar higher here, I would want to play a bounce in the dollar and a pullback in commodities. Watch the dollar here to see whether it starts creeping higher, because even though it had a last 2-3 weeks were down, it could be ready to snap back. If you take a look at the GLD, again, confirmation that the dollar might want to be moving higher here. You see that the GLD broke down on this gray line. We had a break here, worked our way back over the last since the beginning of the year, and we've banged heads with this underside, and we are pulling lower. That tells me maybe this short rally here that has been pushing gold high in the last 4 weeks or so might be coming to an exhaustive end. We'll see how things shape out, but that also plays into the fact that the dollar could be having another move higher. If you take a look at another crude oil, which is another aspect of commodity, we find that we've been unable to break out and stay above about 101, and that also the RSI on a weekly basis has been showing us resistance. You see here, we've been finding it difficult to stay above this area here, and more than likely we keep pushing lower. So crude oil could be pushing lower, gold could be pushing lower, and the dollar could be recovering after it had a nice rally and then a pullback over the last 3 weeks. Again, the USO, which is another way to look at crude oil, you see that, again, I've spoken about this for a while, can't seem to hold this level here, and now you see that the RSI also declining and pushing resistance levels here. Unless we can break out, I think crude oil creeps lower in the coming weeks, which would be consistent with the dollar moving high. Let's take a look at the XRT, which is a S&P 500 retail index. It's another aspect of the market that is breaking out. So we see that the retailing space also following technology as it breaks out, which is pretty good. We'll see whether that's going to hold in the coming weeks. The VIX, which is notorious, and the fact that all its moving averages, the 50-day moving average is pointing lower. You have a declining 33-day moving average, a declining 13-day moving average, and also below its 50-day, below its 200-day. The VIX keeps pushing lower and lower. You have to result or decide to stay on the long side, because this decline in volatility usually coincides with a market that slowly works its way to the upside. Let's take a look at some international markets here, and we are taking a look right now at Brazil. What I like about Brazil here is we have crossover between the 33-week moving average and the 10-week moving average. Okay, we could have a pullback just because the RSI somewhere around here. This is where the RSI stalled previously, and it's back to this level. So any pullback here, we could see that this could be a short-term peak in the Brazilian market. But what I've been saying in other markets is, in our markets, the US markets, is even any pullback is going to have to contend with support on the downside, support coming from the upward trending trend lines. So this is not the market. Once we moved below the moving averages here, then the pressure was to the downside. But now we are above the moving average, so the pressure is to the upside, and any rally or any sell-off is gonna find support on an upward trending trend line. So the market is gonna be relatively bullish for a considerable amount of time. That's what I'm trying to say. The French market, so the French market is also preparing for a crossover between the 10-week moving average and the 33-week moving average. The only way that can happen is with the price movement, and which the only way this crossover takes place is if we have a movement to the upside in price, and then we have a crossover. Since most markets have already crossed over, it makes sense that the French market will also follow that pattern. Take a look at the DAX, the German market. Again, you see that this crossover is imminent, if not taking place right now, and the only way this crossover will take place is with a surge in price, which might explain why we've had a rally in the last couple of weeks to the upside. Let's take a look at the Hong Kong market, the Hang Seng. You see that once the RSI broke out, we had this declining line on the RSI, which was resistance. This line here connecting the top lines on the RSI. Once we broke out here middle of January, which corresponds with that area, it's been a straight move to the upside, and we see that this week, or the first week of February, we see that we are breaking above this declining line, moving above that, also moving above the 200-day moving average. So after we've had a couple of days of rest right there, we are now spiking to the upside. Again, you have to play the upside in this market until the market itself turns around. There's no point to pick highs because it's very difficult. Here is now the Hang Seng from a weekly perspective. Notice how the moving averages look like they're intending to cross over to the upside. What that means is that we could have pullbacks and all that, but eventually we might be pushing higher so that the moving averages could also cross over. Again, crossovers in the moving averages, just like we had this area here, this period here, we had a crossover to the upside, and what followed after the crossover was the markets moving to the upside here. So crossover here, markets move higher. Crossover negatively here, markets move down. So here we have an impending crossover to the upside. Net result is that even if we have a pullback in the market, we could still pull back, settle down, and break out again. So the market looks like it's decent here. You don't want to stay short just because you're used to staying short. When the market changes its look and feel, you have to change your perspective. Here's the London market. We see that as far as price is concerned, We are moving to a 6-month highs, 7-month highs here, which is strong, strong. So it's a breakout here. You have to play to the upside. There's no point in arguing with that. You see that we have impending crossover between the 50-day and the 200-day moving average, which means that still pressure is to the upside. What concerns me about this breakout is the fact that, unlike most markets, the London market has not been able to move above, has not been able to break out on its daily RSI. So we'll watch this to see what this means. But for now, pressure still seems to be on the upside, even if with a markets experience pullback. The FTSE, again, the London market, on a weekly basis, we see that the crossover is taking place right now between the 10-week and the 33-week moving average. Net result is just like we had a crossover middle of 2010, summer of 2010, we had a crossover, bullish crossover. We had a rally. Prior to that, we had a bullish crossover in the middle of 2009. We had a strong move to the upside. So now we have another crossover here, and we might be setting up for a multi-month rally. Take a look at the Korean market, the Kospi. Again, all I want to point out here is, as of right now, we have the crossover of the moving averages. Cannot ignore that. Also, take a look at the Indian market here. Also, we seem to be breaking out of this. We've been trending here to the downside, finding resistance on this top line here for many, almost going back about 1.5 years. But this week, or the first week of February, we seem to be breaking out of that trend, which is bullish. Also, don't forget that we have what seems like impending in the next couple of months crossover between the 33-week moving average and the 10-week moving average. So, that being the case, I'm watching the RSI very closely, because even though the market looks strong, should we start rolling over in the RSI, if this RSI area continues being resistance, then we might be looking down the road and say, remember when we thought the market was breaking out and it was a fake? Because remember, markets can also fake us into going one direction. Needless to say, there's no point in anybody trying to pick the top here. It's very difficult to pick a top, but at some point the market's going to pull back. The nature of the pullback is going to tell us whether it's going to be a strong correction or just a normal correction within a bullish setup. This is Eric Muada with Muada.com. Let's see how things shape out, but for now, we gotta just play the upside. You have to play quality breakouts in the market. Good luck, peace, and blessings.